Hey everyone, this is Jack speaking. Today I'll be explaining what is inflation and how does it work. But before this, let me tell you about the cryptocurrency we're currently populating. Its name is Block Micing Credit Protocol, or BCPT for short. If you're not on it, I would strongly advise you to watch the channel trailer video and join us now while the price is still low, or forever hold your peace. In UK, annual inflation rate jumped to 4.2% in October 2021, which is the highest it has been since December 2011. So what is inflation and how does it work? Inflation is a measure of the rate of rising prices of goods and services in an economy. If inflation occurs, leading to higher prices to basic necessities such as food, it can have a negative impact on society. Inflation can occur in any product or service, including need-based expenses such as housing, food, medical care, and utilities. Or it can be want expenses such as cosmetics, cars, or jewelry. Once inflation becomes prevalent throughout an economy, the expectation of further inflation becomes an overriding concern in the consciousness of both consumers and businesses alike. Central banks of developed economies, including the Federal Reserve in the United States, monitor inflation. The Fed has an inflation target of approximately 2% and adjusts monetary policy to combat inflation in case prices rise too much or too quickly. Inflation can be a concern because it makes money saved today less valuable tomorrow. Inflation erodes a consumer's purchasing power and it can even interfere with the ability to retire. For example, if an investor earned 5% from crypto, stocks, or whatever, and there was 3% inflation, in real terms he only earned 2%. And this is without even mentioning the taxes being cut from that. In this video, we will examine the fundamental factors behind inflation, different types of inflation, and who benefits from it. What drives inflation? There are various factors that can drive prices or inflation in an economy. Typically, inflation results from increase in production costs or increase in demand for products and services. Cost push inflation. Cost push inflation occurs when prices increase due to increase in production costs such as raw materials and wages. The demand for goods is unchanged while the supply of goods declines due to the higher costs of production. As a result, the added costs of production are passed on to the consumer in the form of higher prices for the finished goods. One of the signs of possible cost-push inflation can be seen in rising commodity prices such as oil and metals, as they happen to be major production inputs. For example, if the price of copper rises, companies that use copper to make their products might increase prices for their goods. If the demand for the product is independent of the demand for copper, the business will pass on the higher cost of raw materials to the consumers. The result is higher prices for consumers without any change in demand for the products consumed. Wages also affect the price of production and are typically the single biggest expense for businesses. When the economy is performing well and the unemployment rate is low, shortages in labor or workers can occur. Companies in turn increase wages to attract qualified candidates, which increase the production costs for the company. If the company raises prices due to the rise of employee wages, cost-push inflation occurs. Natural disasters can also drive prices higher. For example, if a hurricane destroys a crop, such as corn, prices can get higher throughout the economy as corn is used in many products. Would you please be so kind to hit the like button as it helps me tremendously to build this channel. Also, if you don't have a portfolio but you want to start building such, or you do have a portfolio but you're not happy with your terrible broker, have a look down in the description. The exchanges you see there are trustworthy and they charge fair fees. Depending on which one of them you decide to go with, they might even give you a welcome bonus. Or you can go with all of them, as I always advise all traders and investors to use at least a few exchanges for an extra layer of safety. And I might get to make a ton of money from your trading in case you're an active trader, but let's not focus on that now. Demand pull inflation. Demand pull inflation can be caused by strong consumer demand for a product or service. When there is a surge in demand for a wide breadth of goods across an economy, their prices tend to increase. While this is not often a concern for short-term imbalances of supply and demand, sustained demand can reverberate in the economy and raise prices for other goods. The result is demand pull inflation. Consumer confidence tends to be high when unemployment is low and wages are rising, leading to more spending. Economic expansion has a direct impact on the level of consumer spending in an economy. This can lead to a high demand for products and services. As the demand for a particular good or service increases, the available supply decreases. When fewer items are available, the consumers are willing to pay more to obtain the item, as outlined in the economic principle of supply and demand. The result is higher prices due to demand pull inflation. Companies also play a role in inflation, especially if they manufacture popular products. A company can raise prices simply because the consumers are willing to pay the increased price. Corporations also raise prices freely when the item for sale is something the consumer needs for everyday existence, such as oil and gas. However, it is the demand from the consumers that provides the corporations with the leverage to increase prices. The housing market. The housing market, for example, has seen its ups and downs over the years. If homes are in demand because the economy is experiencing an expansion, home prices will rise. The demand also impacts ancillary products and services that supports the housing industry. Construction products such as timber, steel, nails, etc. used in homes can also see increase in demand due to increase in demand in homes. Expansionary fiscal policy. Expansionary fiscal policy by governments can increase the discretionary income for both businesses and consumers. If a government cuts taxes, businesses may spend it on capital improvements, employee compensation, or new hiring. Consumers may purchase more goods as well. The government can further stimulate the economy by increasing spending on infrastructure projects. The result could be an increase in demand for goods and services, leading to price increases. Expansionary monetary policy by central banks can lower interest rates. Central banks like the Federal Reserve can lower the cost of banks to lend money, which allows banks to lend more money to businesses and consumers. The increase in money available throughout the economy leads to more spending and demand for goods and services. Measures of inflation. There are a few metrics that are used to measure the inflation rate. One of the most popular is the Consumer Price Index, or CPI for short. It measures prices for a basket of goods and services in the economy, including food, cars, education, and recreation. While in October 2021, the Consumer Price Index showed 4.2% for the year prior for UK, this for United States was 6.2%, which made it the largest increase since 1990 for them. Another measure of inflation is the Producer Price Index, or PPI, which reports the price changes for domestic products. The PPI measures prices for fuel, farm products, meats and grains, chemical products, and metals. If the price increases that cause the PPI to spike gets passed on to the consumers, this will be reflected in the Consumer Price Index. Who benefits from inflation? While the consumers can experience very little benefit from inflation, investors can enjoy a boost if they hold assets in markets affected by inflation. For example, these who has invested in energy companies might see a rise in their stock prices if energy prices rise. Some companies reap the rewards of inflation if they can charge more for their products as a result of a surge in demand for their goods. If the economy is performing well and housing demand is high, home building companies can charge higher prices for selling homes. In other words, inflation can provide businesses with pricing power and increase their profit margins. If profit margins are rising, it means the prices that companies charge for their products are increasing at a faster rate than the increase of production costs. Also, business owners can deliberately withhold supplies from the market, allowing the prices to rise to a more favorable level. However, companies can also be hurt by inflation if it's the result of a surge in production costs. Companies are at risk if they're unable to pass the higher costs to the consumers through higher prices. If foreign competition, for example, is unaffected by production cost increases, they don't need to raise prices. As a result, companies might have to eat the higher production costs, otherwise they risk losing customers to foreign-based companies. Thank you all for watching this video, don't forget to subscribe and you might see me again.